Let's bring in Stephanie Link, Chief Investment Strategist and Portfolio Manager at Hightower, as well as a CNBC contributor. Also with us is our own Steve Kovac. Steph, let me start with you. As you look at what we've seen so far from earnings, they seem to be tracking roughly where they usually do, with more of the companies beating estimates and a few missing.
It's been pretty good, right? About 17% of the S&P 500 have reported. About 76% have beaten. About 20% have missed. So far, so good. The biggest surprise, Tyler, to me, is consumer staples and how resilient they have been in the face of double-digit price increases. They're still seeing very solid organic growth. You guys have been talking about Coke. On Friday, it was P&G. L'Oreal had a gangbuster number, especially out of China. So these stocks are expensive, but they have surprised by being so strong and resilient in the face of all the macro uncertainty. So I actually am feeling a little bit better, at least at the starting point. We'll see. We have a lot to get through this week.
I was surprised to read, Steph, that GE is now, I don't want to jump ahead here. One of the names reporting, obviously we're watching McDonald's in the morning, but GE is up more than 50% year to date. Why?
I know. Well, it's been a great one. Because they spun out GE Healthcare, and they're going to spin out the renewable business in January of next year. So it becomes a much more simple company, a pure play on aviation. And that's the one thing that this company has done an amazing job at. It's really world class. And so now we can focus on aviation. We can focus on the secular growth trends there, on aftermarket, which carries higher margins, and free cash flow. If there's anything that you want to pay attention to on GE, it's free cash flow. And they better do between 3.4 and 4.2 billion this year, because that's what they guided on March 9th.
What are you going to do to them if they don't do that? It sounds like you're going to come after them. I'd love to see that. All right, Steve.
I am going to come after them.
You're going to come after them.
I am.
Oh, with a switch. What's coming up in tech this week? What should we be watching?
Oh, just a measly $5 trillion worth of market cap reporting. No big deal.
No big deal here.
But not Apple.
Not Apple. So Apple's actually next week. They have an extra week, and it's wonky, extra week in their fiscal year. That puts everything back a week. But tomorrow we get Microsoft and Google, or Alphabet rather, the two AI kings, battling it out to see who can win this AI race, particularly in search, but also other products. Microsoft just today, they put out a big blog post kind of bragging about all these clients they have already using AI, that, such as Mercedes and other companies like that. And then the cloud business, also both of these companies really big in the cloud, obviously slowing down quite a bit because we're seeing IT spend slow down across the board. And then we get into the social stocks. We have Meta. And then, obviously, their year of efficiency. I'm calling this the quarter of efficiency because this is when we've gotten through all these AI or these layoff announcements. We've gotten through all these cost-cutting announcements. Now they kind of have to show their work and what comes out of that. And by the way, layoffs might not be over. And then we get Amazon on Thursday.
Wow.
AWS.
What a week.
Yes. AWS also having some issues, headwinds, same as Microsoft with IT spend going down. Then again, they're getting big into AI. They just announced a bunch of new AI stuff that we talked about, Kelly, on your show. And also just the consumer, what Andy Jassy told our Andrew Ross Sorkin just a couple weeks ago, that consumers are trading down. They're looking for deals. So what does that mean for the e-commerce business? It's a lot to digest.